The Federal Reserve is undergoing a fundamental structural transition that marks the end of the post-crisis era of total central bank independence. Newly appointed Fed Chairman Kevin Warsh has taken the helm with a clear plan to curb the Fed's autonomy. In what is being described as a shift toward a Hamiltonian central banking model, Warsh intends to coordinate monetary policy directly with federal fiscal objectives, reining in the Fed's expanding role and focusing its resources on supporting government debt management and fiscal coordination. A cornerstone of Chairman Warsh's strategy is the establishment of a new Fed-Treasury Accord, modeled after the historic agreement of 1951. This accord is designed to formalize and tighten coordination between monetary and fiscal authorities. Analysts note that this represents a shift toward executive influence, aiming to align interest rate policy and balance sheet decisions with Treasury issuance plans, thereby ending the era where the Fed operated in isolation from fiscal realities. This coordination will have immediate structural impacts on the Fed's balance sheet. The new leadership intends to wind down the Fed's massive mortgage-backed securities portfolio, which currently stands at $1.9 trillion. Rather than maintaining a presence in the housing debt market, the Fed plans to drain this MBS portfolio toward zero over the coming years, shifting its asset holdings entirely to government treasuries and removing central bank support from the mortgage market. To prevent a liquidity crisis as the Fed exits its asset buying programs, the new administration plans a parallel wave of bank deregulation. By easing capital requirements and relaxing restrictions on proprietary trading, regulators aim to increase the balance sheet capacity of commercial banks. The strategic goal is to enable private banks to take over as the primary buyers of U.S. government debt, absorbing new Treasury issues as central bank demand declines. This structural transition comes at a time when monetary policy is facing severe inflationary pressures. Quantitative models estimating the market-implied neutral rate show that the Federal Reserve is currently 2 rate hikes behind the curve. This creates a sharp policy disconnect. While political pressure from the administration is pushing back on monetary tightening, internal Fed models indicate that further hikes are necessary to contain nominal demand. The driving force behind this persistent inflation is a pair of massive demand shocks. Analysts point to a procyclical fiscal stimulus, combined with an unprecedented aggregate demand shock from artificial intelligence infrastructure spending, known as AI apex. Together with a structural slowdown in labor supply and productivity growth, these forces are creating a significant output gap, increasing the risk of the nominal economy overheating. The rates market has responded aggressively to these persistent inflationary forces. Following the recent jobs report, the 2-year Treasury yield broke out to a new 12-month high. This yield spike reflects growing market anxiety that the Fed will be forced to resume tightening, introducing fresh worries about policy mistakes and a potential economic slowdown as borrowing costs rise. While yields spiked, bond prices plunged, revealing a major divergence in market pricing. The 5-year TIPS break-even rate fell to approximately 2.48%, its lowest level since March. This indicates that while nominal yields are rising due to supply and policy fears, long-term inflation expectations are actually falling. Analysts interpret this as a market hedge against a Fed policy error. Investors expect that aggressive rate hikes in a fragile economy will trigger a recession, containing inflation. This fragility is already appearing in consumer sentiment. The NY Fed's May survey of consumer expectations showed that while median 1-year inflation expectations decreased to 3.5%, consumer confidence in the labor market deteriorated. The perceived probability of finding a new job dropped to 43.7%, marking the lowest reading since December and highlighting underlying weakness in the labor market despite strong payroll prints. In the equity markets, these macro pressures are colliding with historic valuation extremes. Large-cap technology stocks have outperformed the broader S&P 500 by an unprecedented 29.3 percentage points over the last 50 days. Technical analysts identify this as a rare Six Sigma outperformance extreme, a level of concentration unseen in a decade that suggests a high probability of a sector pause or tactical rotation. This technical extreme is particularly visible in the divergence between hardware and software. Semiconductors have outperformed software by 44 points over 50 days, a 4 sigma extreme. Value managers suggest rotating towards resilient software-as-a-service companies that are trading at steep discounts. For instance, Intuit is trading at $323, compared to intrinsic value estimates of $631, backed by $7.8 billion in annual free cash flow and 80% gross margins. Adding to broad market volatility is a structural shift in trade policy. U.S. average import tariffs have skyrocketed from their historical 2% range, marking the end of the post-war multilateral trade era. Analysts from the Hoover Institution warn that tariffs on batteries and solar panels are increasingly being used as geopolitical leverage rather than purely for environmental goals, raising supply chain costs and adding to index volatility. In a complex market defined by central bank transitions, tariff volatility, and energy risks, such as the Middle East conflict threatening to drain oil inventories to operational minimums by August, selectivity is essential. With the planned $3 trillion in global AI capital expenditures over 3 years, dwarfing current AI revenues of $80 billion, investors must focus on capital preservation. The key is to maintain cash and invest only in businesses with robust free cash flows and strong balance sheets.